You have heard the saying that you should be greedy when others are fearful, but it takes serious guts to actually buy a stock that is crashing. Today, we are looking at 5 massive companies that have been beaten down by 40, 50, or even 60% from their all-time highs. These are not speculative penny stocks, but dominant industry leaders that are currently trading at valuations we have not seen in many years. The stock market is a device for transferring money from impatient to patient. And right now, the market is offering us incredible deals. We are focusing on high-quality businesses that are facing temporary headwinds, solvable problems, or simply negative market sentiment. Just remember that catching a falling knife can be dangerous, so we need to look at the fundamentals to ensure these companies can survive. Our first pick is the absolute king of athletic apparel, Nike, which has been stumbling through one of the toughest periods in its history. The stock has been hammered because of slowing sales in China and increased competition from newer running brands like Hoka and On Running. However, Nike recently brought back a veteran leader as CEO to steer the ship back to its roots of product innovation and bold marketing. The company is currently executing a massive cost-cutting plan while refocusing on wholesale partners it previously ignored for too long. With the stock trading significantly below its historical average valuation, the downside risk appears limited compared to the upside potential. The brand loyalty for Nike remains unmatched globally, and history shows that betting against the swoosh is usually a losing strategy. Next on our list is the fintech giant PayPal, a company that the market seems to have completely left for dead over the last 2 years. PayPal shares have fallen dramatically from their pandemic peaks, pushing its price-to-earnings ratio down to a shocking 13 times. Investors are worried about competition from Apple Pay, but they are ignoring the massive free cash flow this business still generates. The company is aggressively buying back its own shares, which artificially increases the earnings per share for you as a loyal shareholder. They are also launching a new advertising platform in 2026 that could unlock a completely new high-margin revenue stream. When you can buy a profitable tech leader for a valuation cheaper than the S&P 500 average, you are looking at a classic value play. Our third beaten-down contender is Starbucks, which has been suffering from operational inefficiencies and rising prices that annoyed customers. The stock took a beating as traffic slowed, but the board made a decisive move by hiring Brian Niccol, the genius who fixed Chipotle. His back to Starbucks plan is already in motion, focusing on getting coffee to customers in under 4 minutes and fixing the cafe vibe. Turnarounds of this magnitude take time, but the market is starting to believe that the company can return to consistent double-digit growth. While you wait for the operational fix to kick in, you are collecting a respectable dividend that the company has prioritized protecting. The biggest risk here is execution, because if the new CEO cannot fix the wait times, the premium valuation might compress even further. However, with institutional investors slowly piling back in, the risk-to-reward ratio for Starbucks looks very attractive for the long term. Now, let's talk about a stock for the income investors, the pharmaceutical giant Pfizer, which has been in a painful post-pandemic slump. After the massive revenue cliff from the decline of COVID products, the stock price drifted down to levels that pushed the yield over 6%. This is a classic dogs of the Dow scenario where you get paid a massive dividend just to wait for the market sentiment to eventually shift. Pfizer has been using its cash pile to acquire smaller biotech firms, building a massive pipeline of oncology and rare disease treatments. The market is currently pricing the stock as if it will never grow again, which is historically a great time to start building a position. If you reinvest those fat quarterly dividend checks, you can compound your wealth significantly even if the stock price stays flat for a while. Just be aware that pharmaceutical stocks are volatile due to patent cliffs, so this is strictly a long-term play for patient income investors. Our final pick is the most aggressive one on the list, a fallen angel in the renewable energy sector called Enphase Energy. This stock was a market darling that crashed more than 50% in 2025 due to high interest rates hurting solar demand. When interest rates are high, homeowners are less likely to finance expensive solar setups, which caused Enphase revenue to drop off a cliff. However, as interest rates eventually normalize, the demand for residential solar and battery storage is projected to bounce back aggressively. Enphase maintains a dominant duopoly position in the inverter market, meaning they have massive pricing power once the cycle turns positive. Buying a cyclical stock at the bottom of the cycle is terrifying, but it is also where the legendary multi-bagger returns are usually found. If you can handle the volatility, adding a small position in a beaten-down growth stock like this can add serious torque to your portfolio. Now that we have covered the 5 stocks, we need to discuss how to actually buy them without blowing up your entire account immediately. Never go all in on a beaten-down stock at once, because a stock that is down 90% is just a stock that was down 80% and halved. The best strategy is to dollar cost average, meaning you buy a small amount every week or month to smooth out your entry price over time. This protects you if the stock drops another 10 or 20%, which is entirely possible when you are catching falling knives. You should also ensure that these turnaround plays do not make up more than a small percentage of your total diversified investment portfolio. Turnarounds can take years to materialize, and you do not want your financial future tied to performance of just a handful of struggling companies. It is also vital to keep an eye on the earnings reports for these companies to see if the turnaround thesis is actually playing out. For Nike, watch the North American sales numbers. For PayPal, keep a close eye on their active user margins and transaction volume growth. For Starbucks, you want to see same-store sales turn positive. For Pfizer, watch the pipeline approvals. And for Enphase, watch interest rates. Investing is not about being right every single time, but about finding asymmetric bets where the upside is far greater than the downside. These 5 companies have strong balance sheets, recognizable brands, and the resources to survive this downturn and emerge stronger. The market sentiment is currently very negative on them, which is exactly why they offer such compelling value for contrarian investor. Most people wait until a stock is already doubled before they get interested, but by then, the easy money has usually already been made. You have the advantage of information and patience, allowing you to plant seeds today that could turn into massive trees in the future. Remember that this is not financial advice, but a starting point for your own research into these fascinating market opportunities. I want to know which of these 5 stocks you would be willing to buy right now, or there is another beaten down stock I missed. Drop a comment below with your top turnaround pick for 2026, because I read every single comment you guys post. If you found value in this deep dive, please hit that like button to help the algorithm share these opportunities with more investors. Make sure you are subscribed and have the notification bell turn on, so you do not miss our next breakdown of the market's hidden gems. We are working on a video about the best dividend ETFs for passive income, and you definitely do not want to miss that one next week. Thank you so much for watching. Keep investing wisely, stay patient with your winners, and I will see you in the next video.